You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
There's some things that are happening. UBS, for example, is down almost 5%. So we want to get you some analysis here with Alison Williams, Bloomberg Intelligence Senior Analyst, Global Banks and Asset Managers. So basically, there was a fourth quarter earnings miss. It did announce a buyback of up to $1 billion in shares this year. So you can make an argument, Alison, there's something for the Bulls, there's something for the Bears. What was there for you?
So I think, investors got as much as they could today. The issue is it's going to be a long time frame for this deal to execute, which I think investors should have been prepared for. They may have wanted a bit more. The one negative thing for the outlook is that 2024 estimates are likely going to come down a little bit because, the returns are going to be lower. But that's because I think UBS is trying to be aggressive in, pulling forward those costs. So they did upsize the costs on a gross basis, but they're going to invest those, so not falling to the bottom line. So perhaps some disappointment there. They did reiterate their sort of 3-year target. They gave a longer-term target that was in line with the high end before Credit Suisse. So I think those were all positive. The buybacks also a little bit better than expected. The big positive news was 27% increase in dividend, though also, as you said, fourth quarter, not so much great things going on there. So the miss was on costs. Their adjusted costs fell. Their integration costs or the restructuring costs were much bigger than expected. The wealth flows moderated a little bit, and the investment bank lost money.
Alison, what is the new UBS here post Credit Suisse? And full disclosure, I'm a client of UBS. Used to work at Credit Suisse, so I'm all over the Swiss stuff here. But where does UBS want to be now that they've acquired Credit Suisse? What are their ambitions vis-a-vis a global financial institution?
So I don't think that the big picture strategy has changed much for them, right? So their focus is on wealth. They're the premier global wealth manager. They added some assets. They added some relationships with Credit Suisse. In the investment bank, again, they're still focused on equities. So even though profit disappointed, revenue came in about in line. So that's a positive thing on the equities trading side of things. They did add, some incremental ads. There were some numbers around the traders. The Bloomberg News reported. We obviously look at the top line of revenue. They kept the M&A and the research areas were the areas that they added to. And those areas did pretty well in the quarter.
So what else do you need to hear to get more confidence in all of this? We need just kind of hold and wait for 2 more years, basically?
I think it is like a show me, right? So I think it's going to be a step by step. So Armati, as you know, said this morning that they might sacrifice a little bit of revenue because they are focused on profitability. They're focused on doing things right. So again, those are the types of things that you have to have confidence. He has done a big turnaround at UBS before, but I think that it is the kind of thing where it's like quarter by quarter, investors have to start to see, some of the, some support for these estimates. Another target they put out there this morning was $100 billion per year for the next 2 years in net new wealth assets. So I think that's a pretty good target. But again, we saw some slowing in the fourth quarter. Some of that was mandates leaving with Credit Suisse relationship managers. Still pretty stable, but I think investors will want to see, more. So, over the next few quarters, UBS delivering on its plans.
So, Alison, you cover everything, all the global big investment banks, commercial banks here. Is the global bank, is that just left to the Morgan Stanleys, the Goldman Sachs? It doesn't seem like anybody in Asia, anybody in Europe can compete against the JP Morgans of the world.
So, Paul, it's really been over the last decade, ever since you left the business, but
it was Paul. It was all Paul.
Last decade, the U.S. banks just really making those market share gains. Credit Suisse is sort of the latest to provide some gains to those U.S. players, if you will. Keep in mind that the sale from UBS follows them exiting prime brokerage. Before Credit Suisse, we had Deutsche Bank, who also exited prime brokerage. They shed parts of their fixed income business. If we went back to several years prior, there was a lot of the European players getting out of FICC. And, keep in mind, it is a scale business. And I think where banks like JP Morgan have been winning, and in fact, Goldman Sachs, who has gained the most market share over the last several years, are that they are investing in technology that helps them get better revenue, that helps them have more money to invest. And so it's really that virtuous cycle that some of those big U.S. banks have been enjoying.
And before we let you go, let's talk about you cover everything. KKR doing particularly well also. What's driving some of these private equity guys to outperform at this point?
I think, if you look at the asset management industry, right, like the two areas of growth are private markets and passive. The big difference is that private markets has very significant fees. And since you've seen these big companies go public, I mean, the fundraising is just impressive.
Mm-hmm. Great stuff. Alison's the best.
She is, absolutely. I wonder who hired her. Alison Williams, Senior Analyst,
that
Global
was Paul.
Banks.
That's
Should
never
I
going to get
pat
old,
him on the
is
back,
there?
or you want to do it yourself?
Exactly. That's patting myself on the back there. No, but she's the best. Alison Williams, Senior Analyst, Global Banks, Bloomberg Intelligence. Before she came to Bloomberg Intelligence to cover banks, she was at Morgan Stanley Investment Management on the buy side.
Amazing.
As a senior analyst covering banks there for all their big funds.
I just don't like. All these banks have different business models, and I do not understand how you keep them all straight. Like, at least oil companies, like, they dig for stuff and they get it out of the ground. Like, they may dig in different places, but it's pretty straightforward.
I mean, back in college, I wrote a paper on the 5 biggest investment banks in 25 years, who they were going to be. One of them was Deutsche Bank. And for a while, I was looking really good there until not so much.
Although, I mean, we thought they weren't going to survive 2016. So we thought we were all like beating the drum to total bankruptcy or someone buying it, like, UBS or Unicredit, and that didn't happen. So
and you just look at the European banks, and they just haven't evolved with the times. The governments haven't allowed cross-border consolidation, and so the net result is in this global world, they're nowhere. I mean, nowhere. Deutsche Bank, UBS, they're regional banks now, and it's a shame because there was a time when you really thought that they could become a global financial institutions. So we'll have to see. Now it's up to the JP Morgans and Goldmans and the Morgan Stanleys of the world. So good stuff.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Administrator Mike Whitaker is on Capitol Hill today, and he'll be talking about the latest Boeing news and how the FAA is going to have a little bit more oversight. And just to add some color to this, Spirit Aerospace is on their earnings call right now. They weren't able to give guidance because of what's going on with Boeing. And they say that their goal, is to have 0 production deficits. That's good goal, thank you. They say they're fully aligned with Boeing. They plan to have more automation of some manual tasks. They've added inspectors, assessed plug sequence with Boeing, like they're doing all the right stuff, and they have made progress, they say, in stabilizing the 737 production in the 4th quarter. So what does this all mean? Like, do we want FAA regulators like getting involved more Boeing planes? Is it better? Is it worse? They were already involved. It's confusing.
I don't know. But George Ferguson, he knows. He might know. He covers all this aerospace and airline stuff for Bloomberg Intelligence. George, what's the latest here? What changes do you think may come to the FAA, may come to Boeing?
What we heard from Whitaker in some of his initial comments was that rather than auditing Boeing's safety, they're going to have a physical presence on the line, and that they would push some of that presence down into Spirit Aerosystems. I suppose that means they'd push it also into other suppliers. I mean, I frankly think it's a good thing, right? I think that clearly right now the way the system is set up, it's not working well. We've talked about it. I think it's largely due to turnover. As we went through the pandemic, I think we lost a lot of talent at these companies. But so clearly we're having a breakdown in the manufacturing process, and I think the FAA is here to regulate and I think this is something that puts the long-term health of the U.S. aerospace business at risk, and they're here to help protect that, right? And so putting them down in the line, I think, is a positive. It may slow things down, but I think for a good reason, so that you get quality through there, and folks can trust the products coming out of Boeing and other U.S. aerospace suppliers.
Why weren't FAA regulators already there and have a physical presence?
Well, so I think they were largely handling things from an audit standpoint, right? Reviewing processes and certification. I think that they've been stretched thin through the pandemic as well. They haven't had enough workers as well. A lot of turnover, and I think also I think this business was a simpler business if you go back 20 or 30 years ago. I know that's a long way to go, especially when I'm talking to people in financial markets. Yeah. But if you go back 20, 30 years ago, the supply chains didn't stretch as far. They were a lot more domestically focused, a lot more vertically integrated, and that's been changed dramatically over the last number of years. And I think Boeing got on the cutting edge of that when they built the 787, and I think that's created some challenges here. And now I think the regulator as well as the manufacturer has to figure out how they can manage such a far-flung supply chain and make sure quality comes through on the line. So I think the world's a little bit different, and that's one of the reasons why it's changing.
What's that mean for the economics of Boeing? I mean, there's a school of thought out there that maybe 10, 20 years ago they kind of maybe made the choice to focus a little bit more on shareholders than maybe on the engineering of the company, engineering pedigree, and that's arguably worked out well for shareholders. Is there a sense that they maybe went too far and might have to kind of retrench a little bit?
I think there is a sense that they went too far, right? I remember going to meetings with the old CEO McNerney and even Muhlenberg a couple CEOs ago, and they'd get into the meeting with the analysts and talk about how they had a cash-generating machine, and I think that's really great, But at the end of the day, these are engineering businesses and manufacturing businesses, and I think they've got to look again at investing in the people that build these aircraft. It's not like an auto plant where you have a lot of capital equipment in there. You've got robotics, you've got jigs and everything like that will really help support workers that maybe aren't as trained as an aerospace worker. Aerospace has a lot less of that. The volumes are lower. The work is a lot more. It can be complex. It can be very specific, so much so that you can't get a capital tool on it or a machine on it. And so you really need a seasoned workforce there, a well-trained workforce. And I think that's where they need to be, right? They need to get reinvested back in that workforce and in that process.
I have a really dumb question, so excuse the dumb question. Why is it so hard? Like, I understand that building big things that carry people is difficult, but doing it well shouldn't be hard for a Boeing and an Airbus. They're the only two guys who do it. So, where have they gone so wrong that they have to sort of drill down this much?
Well, I guess I would say it's so hard because the tolerances are so tight, right? Meaning you can't make a mistake in this business, right? You and I go to work, I can make a problem in a spreadsheet. It's okay, I'll probably figure it out in a couple hours or something like that. You can make a bad car, and when it breaks down, you pull it to the side of the road and you get the tow truck. It's not the end of the day. This is a zero tolerance for defects business, and that means every little miss is noticed. And that's why I think it's so hard.
Fair enough.
Is Boeing, are they taking new orders now? How is it day to day for them? Are they still
their backlog's still huge,
selling
I
stuff?
think,
Yeah.
right?
I mean, they're absolutely open for business taking orders. I haven't seen many orders flow through lately. I have heard some customers like Ryanair that are always looking for a good deal say that if anybody doesn't want their airplanes, they're willing to take them. But I mean, on the sales side, absolutely, I think they're open for business. And on the manufacturing side, that's the challenge here too, is they're not going to shut it down. Mm-hmm. They're building at a 38 rate. They've got to do that as well as possible while improving it. And then we're going to wait and see what changes the FAA may want as they get involved here. But they're still running the business while they try to make these improvements.
Because, I mean, for an airliner, for example, you put in orders and it's years in advance, right? So they kind of have to stay in the queue. But if the deliveries are pushed out, what airlines have enough of like old planes that they can still do the stuff?
Yeah, so the global airline fleet, like I could take the next couple hours to talk you through it, but
you got like 90 seconds?
Yeah, I mean, there's a lot of them that have older fleet that can rely on it. Right now, there's been no change to Boeing's build strategy. They're building at the 38 that they broke to at the end of last year, and if this FAA, analysis takes longer than 6 months, maybe we get into a situation where Boeing can't go to the next build rate that they had projected as they told customers they could have airplanes. I could tell you that there's a lot of folks, a lot of airlines in the world that expected airplanes, even from Airbus, at certain dates, that are having to push some of those out and make make provisions with either lessors or using older fleet so that they can cover the schedule they want to fly. So this is not just a Boeing issue; it's sort of managing not having airplanes ready.
All right, George, thanks so much for joining us again. George Ferguson, Senior Aerospace, Defense and Airlines Analyst, Bloomberg Intelligence, on the Zoom cam from Bloomberg's headquarters down in Princeton, New Jersey.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
A bad day for President Trump and his legal team. Can you put this in context for us?
Sure, yes. It's a speed bump in his legal journey, I guess you could call it. A 3-judge panel of the D.C. Circuit Court of Appeals, which is actually the U.S. Circuit Court of Appeals based in D.C., has ruled that Trump's argument that he is immune from criminal prosecution because he was president when he was allegedly committing these crimes related to the insurrection at the Capitol on January 6th, that his argument is wrong, that he has no immunity and he can indeed be prosecuted. Trump has just said that he was going to appeal that decision, and that would go to the full U.S. Circuit Court of Appeals for the District of Columbia, and then presumably on to the Supreme Court if he doesn't like the answer from the 9 judges.
Wendy, do you think that it will get to the Supreme Court? We were debating whether or not they would take it up if it got there.
It's always hard to tell what the Supreme Court will do. I have no doubt that if the 9-judge panel agrees with the 3-judge panel, that Trump will appeal it all the way to the Supreme Court. And it's one of those basic fundamental constitutional questions that, frankly, the Supreme Court would probably be interested in taking up, because it will determine once and for all whether a president has immunity. Now, a president, we've never faced this before, first of all, but also Trump is arguing based on a 1982 Supreme Court decision that in civil cases, a president is immune from civil lawsuits for acts he took as president. But a civil lawsuit and a criminal indictment are two very different things.
So lots of questions here. One of them is just timing, Wendy. Do we have any framework for how the 1, possibly 2 appeals would take?
We don't. Former President Trump has until Monday to file an appeal, or to say he's going to appeal, I think. So he has till Monday to do that. Then we don't know how long it would take the full court to decide, and then the Supreme Court may or may not take its time, depending on how complicated the issue is. I like to think that these courts would not act based on politics, and there's no reason to think they would. So they may just see the case as easy and decide quickly, or they may decide to take more time. Mm-hmm. But either way, the clock is ticking toward the November election.
Wendy, let's just play it out for a second. So let's just say that this sticks in whatever way, and he's not granted criminal immunity. Then what? Like, what does that do to the November election?
Well, what it does do is allow Jack Smith, the Justice Department special prosecutor, to move forward with his case, charging Trump with responsibility for the January 6th attack on the U.S. Capitol in 2021. And Jack Smith says he's ready to go and would like to do this case quickly. So presumably, if the courts act in time and the question of immunity is settled so that a trial can go forward, then we could be looking at a trial on that case before the election.
So is there any consensus in Washington about how this will play out here? Because it doesn't seem very good for the former president, just from my read, which is totally uninformed.
No, well, it's not. It doesn't look like it's going to be good for the president. The laws are pretty clear, and the argument that Trump is basing his appeal on, that he's immune from civil lawsuits, has no application to the criminal statutes. So, it doesn't look like it's going to get any better the higher up he goes in the judicial system, but one never knows. Different judges see different things.
Wendy, how does this play with voters? Because clearly his base is going to assume that he's being unfairly prosecuted anyway. So that in some ways helps the base. We see every time there's a new indictment, he gets a load of fundraising money. So who does this actually sway in terms of voters?
This doesn't sway, well, it doesn't sway voters either way. People who don't like Donald Trump think he should be prosecuted. A lot of Trump supporters do believe that this is politically motivated. They buy his line in campaign rallies that this is a quote-unquote witch hunt. And so this is just another step in that road toward that. However, our recent Bloomberg News Morning Consult poll published last week said that 53% of voters in the important swing states would not vote for Trump if he were convicted of a crime. And that includes 1 in 4 Republican voters in swing states. So if he is convicted, that really could damage his reelection prospects.
All right, Wendy, thanks so much. We really appreciate it. Thank you for jumping on with us. Wendy Benjaminson, a Bloomberg Washington Senior Editor, on that story. I don't know. I think anything's going to get so political. It's going to be so hard to see the forest and the trees.
Yeah, I just don't know how the timing is going to work, and just a lot of hurdles there. But moving forward, I guess, is kind of the story.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
David Bahnsen joins us here. He's the Chief Investment Officer for the Bahnsen Group. David, again, John Tucker was looking for some theme to talk about here in this market. I don't see a lot here. We got a ton of earnings going on out there, but it seems to be everybody's just kind of waiting on the Fed. I don't know. What are you guys looking for in terms of direction in this marketplace?
I always am looking for company earnings and actual activities from the businesses we invest in. In other words, a day like today is the way it's supposed to be. The market's trading around the size of the briefcase Jay Powell carries to a press conference. It strikes me as very unhealthy. Market's trading around Simon Property having a blockbuster earnings result last night. Now that makes a lot of sense. So you see the largest mall operator in the country up 4.5% today. It was a name I talked about with you guys last time I was here. We're bottom up people. We're markets are businesses doing things kind of people. I'd like to see less of the obsession with Jay Powell, quite frankly.
Okay, so then what do you like? Like, what's working bottom up?
I think bottom up, you have to look at the spaces that are not overvalued, even though some of those overvalued names have done well. It's not been the quarter everyone seems to think it has for Mag 7. But Tesla's gotten crushed, and Microsoft had good results, but not a great stock result. Facebook had a huge upswing on a dividend announcement. It's been very mixed. We're looking at things like consumer staples that we think are showing their pricing power, growing dividends, and if it is going to be a boring year, that will be a good thing for sectors like that.
But does that mean that you sell tech, or you just don't want to buy them here?
Well, for us, we don't have to worry about selling it because we didn't buy it to begin with. And
so you don't own any of the big Mag 7 or 6?
Not a single one, and so that's why
Is that a valuation call, David? Or
it's totally valuation call.
Okay.
These are 7 of the best run companies in history that have done extremely well, and they have a blended negative return over the last 2 years. And I don't think people realize that because 2023 was so good, but it was mostly just offsetting what was so bad in 22. And we think that's what it's going to do. That's what companies that trade at 30, 35, 40 times. Facebook right now has a higher forward multiple than it does backward after last week. That's just crazy.
So how do you screen for stocks? What's important to you guys at the Bahnsen
Dividend growth. So it starts with companies that have a dividend higher than the S&P. Generally, we want 100 basis points or so higher than the S&P, but then a track record of growing the dividend. From there, that's the screen, as you asked.
Yep.
Then we start doing our work. Then we have to research. We want management that's committed to the dividend, committed to growing it year over year. They can only do so if they have a company that has recurring free cash flow. So if the free cash flow or the business model itself lends itself to lumpy earnings, it may not be a good dividend payer. It has to have a strong balance sheet. It's a little bit more boring. You get a lot in healthcare. You know why we did so well last year was financials. The asset managers, Blackstone was up over 80%, Apollo and Blue Owl were up 50%, even though consumer staples and healthcare were laggards last year. But again, on a 2-year basis, they're beating everything else because 2022 mattered. So that's our approach, and we don't try to time in and out of it. I don't know if NVIDIA is going up another 50% or not. I do know if it does, it's multiple expansion. And we do not invest on multiple expansion. We invest on free cash flow growth.
Do you like big oil?
Well, I love oil, small, little, medium, and big. But
you found a friend here.
I think that that's where you get the great dividend growth.
That's what I was asking.
And I think that the Biden administration policies are very favorable to big oil and very unfavorable to small oil. They're not allowing a lot of new projects, which makes the projects that Exxon and Chevron already have in the ground much more valuable. Enables them to go buy Hess and Pioneer respectively, and their Permian market share is just exploding. So both Chevron and Exxon we think are great plays, but they're not our biggest energy exposure. It's midstream. So we own an ETF. The ticker is UMI. It's actively managed, has about 18 different pipeline names, export LNG terminals, but it's actively managed around that midstream energy infrastructure story. Last year, energy was down a couple percent. Exxon was down a little. Chevron was down 9%. Midstream was up 16%. The MLPs were up 25% for the 3rd year in a row. So we do like the midstream energy story.
What gets you to sell a name? Is it they cut the dividend, or they just say they start doing stuff that might put the dividend at risk?
Cash flow or something?
Yeah. Those are all good answers. It could be opportunity cost. There was a company, Cardinal Health, we bought for about $50. It's a fantastic dividend grower. It got to 110. They continued growing the dividend. They were executing, but at that point, we got 5 years of return in 1 year, and we just exited simply to be able to pursue better opportunities. We're selling MetLife today, as a matter of fact, and that's a name we've owned for a few years. But it's a company that is not growing its dividend in cash, but it is growing at dividends per share. So we're getting more dividends per share, but they're just paying the same amount because they're buying back so much stock. When they're buying back 3 times as much stock as they are paying dividend, we don't like that. But when your question about if they cut the dividend, do we sell it? It's our job to not let that happen. We need to be in front of companies that will cut the dividend. And some of the sort of career-making moments for me were deciding against the grain to sell companies we believed were at risk of cutting the dividend, ended up being right later.
So how do you identify those companies? You just see their free cash flows maybe slowing, or?
Yeah, my favorite story of all time is 2007 Citigroup, when they continued to pay the dividend and then were borrowing $12 billion from Saudi Arabia. You say, this doesn't look right to me. And I think, when free cash flow goes negative and the dividend keeps going, then they're basically taking advance on the credit card to pay the dividend.
So do you get heat from investors, though, in terms of not being in big tech and being in big oil? Because that's like the reverse of what the cool, trendy thing, ESG thing is.
That's a really good question, but we actually don't take heat for it. But a lot of that has to do with self-selection of the client base. The types of people that like working with us might be more predisposed to that. But also, we're incredibly communicative. We explain why it isn't. There's a certain ideological bend in this. Obviously, there is on the ESG side. For us, we really believe we have a fiduciary duty to find the right investment opportunities for clients. I'm not against big tech ideologically. I'm against big tech not returning cash to shareholders. I think that it is absolutely inexcusable that Apple is paying tip money out to investors when they're making more cash in a year than most of the S&P makes in a lifetime. It's just, to me, it's unfair treatment of shareholders, but I understand the argument. There's always people who ask about it, but look, Netflix was up 1,000% last decade, and it gave back all of that return in about 6 months in 2022. So I'm a child of the 90s. I grew up beginning investing money professionally in the 90s. I saw what happened. Cisco today is sitting around $50. It was $80 in 1999. And it's grown earnings and profits and revenues every year. It's executed perfectly. It was just plain overpriced. And when you buy something that overpriced, you risk decades of lost return. We're just unwilling to take that risk.
So what do you think what's a dividend yield that screens well for you? Is it by industry, by company, or do you say I need at least a 2.5% yield or something like that?
Yeah, I mean, universally we tend to want about 2.5 just to start, but there's some sectors where that wouldn't be nearly enough. The portfolio blends to about a 4 handle yield, and that's more than double the S&P. And so you're going to end up with some higher yielding names: Simon Property, Lamar Advertising.
I love Lamar. Took them public.
It's a wonderful, wonderful company.
O'Reilly brothers.
Wonderful company. You talk about shareholder alignment. Family owns so much of it. They're going the dividend every year. Our midstream energy stuff is over 5% yield. So you get some higher yielding names. You're going to have lower yielding names on some of these ones that it's just priced in. You know, McDonald's, I think we talked about last time. That's a lower yield now, only because we're up 600% since we bought the stock. Same for Walmart. Walmart went public the same year I was born. They've grown the dividend every single year. So you end up with a lower yield right now. But our yield on Walmart and McDonald's is like 40% on purchase. We're getting 40% year over year from what we bought the stock at. That's what the whole point of dividend growth is.
I just have 30 seconds, right? Are you competing with money market funds in terms of getting money in clients?
No, you're always competing with the risk-free rate in the fact that people have to bench it against something, but they're not people saying I'm considering either money market or a dividend portfolio. It's a totally different risk profile. It's true in a macroeconomic sense, but it's never true in a microeconomic sense.
Good stuff.
How's the weather out in your neck
Here
of the
we
world?
go. I
Well,
knew
here's
this was
the thing.
coming.
I'm sitting here in Manhattan. The sun's out. It's beautiful. It's a little chilly. California having the worst rainstorm that they've seen, which of course there people wouldn't even, around the country they wouldn't consider it a storm, but in Newport they'll probably end up canceling school for a month.
Well, I saw some of the video coming
Looks
from the
really
storms.
bad.
It's pretty bad. They've gotten a lot of rain. It's a little worse inland, but yeah, we get this like once every 100 years.
Yeah. All right. Some hopefully good snow up in Tahoe for the skiers. David Bahnsen, thanks so much for joining us. David Bahnsen, Chief Investment Officer, Bahnsen Group. Dividend yields. That's one of the many reasons we like to talk to David, because it's a strategy we don't hear enough about.
It's true.
So, but
and also just how the risk profile is factored in when you take a look at the S&P dividend yield and sort of how to manage that.
Yep.
I think that's interesting.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Bloomberg Intelligence, where we're going to tap all our analysts that cover about 2,000 companies and 130 industries that we cover worldwide. But we're going to tap someone else right now in the ETF world for her take on the market. And that's Sylvia Jablonski, Chief Executive Officer and Chief Investment Officer at Defiance ETFs. Great perspective on sort of what the trends are in the market and what people are doing with their money. Sylvia, thanks for joining us. We appreciate it. What are you seeing most right now as we're sort of in the second month of the year after a very bizarre 4 weeks?
Hi, Alix. Great to see you. Yeah, I mean, it definitely has been a very bizarre 4 weeks. What's really interesting, and I think what's pretty good, is that some of the positive momentum that we had towards the end of the year has continued into this year. And that blip on the radar that we saw those first couple of days in, have kind of just faded to the wayside. So what we're seeing on our side is just this continued, exuberance and excitement about the AI trade. Most of the flows that we've seen have come into that space. So quantum computing types of stocks, AI stocks, machine learning, kind of an expansion of that ecosystem. So before it was just NVIDIA and AMD, and now people are sort of looking at companies like Palantir, who you just mentioned had, a great earnings report, and Taiwan Semiconductor, IonQ, IBM, some of these other players in the AI space. And it's just been, off to the races there.
All right. One of my favorite ETFs out there is a Defiance ETF, CRUZ. I'm fascinated with the cruise business, the economics of the cruise business, and I actually even may go on a cruise coming up very soon.
It's peak cruise now, I feel like.
I'm being pitched.
Yeah,
it's peak cruise when I go on it. Sylvia, what do you see in that industry these days? What are the drivers?
Yeah, so I think it's been really interesting to watch the cruise business, and what happened during COVID is everybody, vividly remembers the cruise business just came to an absolute halt and just took on so much debt, and it was just a complete disaster, right? And I think we're at the point now, just listening to these last earnings calls where, you had the CEO of Carnival, of Royal Caribbean, even the outlooks from Norwegian, the spending is back. And what they're saying is that they have more cruises booked for 2024 than they did pre-pandemic, finally. The average consumer is spending a lot more, sort of finally, and they're able to kind of like reduce their debt and have stronger profit margins and things like this. So I think the reason that that's holding up, the whole travel trade in general is holding up because the economy is holding up, right? The consumer remains strong. That wage growth, 4% number, good jobs numbers, inflation is coming down. The Fed is eventually going to stop hiking. And I think that, people feel like they can still spend a little bit, right? And that transition from goods to services and travel and experiences, I mean, it's continued to forge ahead.
So have we seen at the same time, pivoting off of that theme, the money kind of coming out of money market funds and into stocks in that, like, yeah, things are getting better. Rates will go down, albeit the last couple of days we've seen a nice move up higher in yields. But I'm going to go put my money to work in economically sensitive stocks. They're actually going to benefit because things are going to get better. Rates will come down. Are we seeing this flow happen yet?
No, and you make a really great point there, right? You'd think with the performance that we saw in the S&P 500 and in NASDAQ last year in particular, that money would be just really piling off of the sidelines. And I think it's going to be a slow trickle in. You still have a lot of clients out there and investors that probably have, things like CDs or instruments that mature at certain times, and they'll kind of scale back into the market when that happens. But I also think that, once you see a year like 2022, and like probably every investor or many of the investors that went to cash held all the all the tech stocks and just got hammered down 30-40%. So they didn't catch it this year. It's just kind of, behavioral finance a little bit there. But I do think that money will eventually come off the sidelines. I mean, look, at the end of the day, you're never going to get rich in treasuries, right? I mean, unless you're worth multi-millions of dollars, I guess. But I think for the average investor that has a longer term time horizon, that 10% annualized return on the S&P 500 plus these kind of like gravy years where you hold a little bit of semiconductors tech and get some outperformance, I mean, that's wealth building, right? So I do think it'll eventually kind of pile back in, and then it'll matter for markets. Then you'll start to see a little bit of a tailwind there too.
I asked this, Paul, because like I'm totally talking my own book. Like,
sure.
4 months ago, put some money in 3-month T-bills. That was an easy call.
Yep.
Those 3 months are up. I don't know. We're
like
now.
Risk.
Now what do we do? Right.
Yeah, now
so
I think you go long meta.
But like I'm the kind of person that wants to like put gold bars and soup cans under my bed, right? So it's I asked to talk my book, but also I really am curious as to like people like me, of which I'm sure there are many, how they make those decisions, Paul.
I don't know. I mean, I would hire a professional or go buy an S&P 500 ETF. Let's be honest.
Let's just be honest.
All right,
sit there for a while.
Sylvia, I saw one of the names on your list that you recently were adding was IBM. Old school tech. What's the thought there?
Yeah, so interestingly enough, the old school tech company that everybody kind of forgets about is one of the the best kind of leaders with the most experience in AI. Watson X has been around probably before AI was a word, right? So they were kind of the first ones doing it. They've spent tons of money in R&D. They've been hiding under a rock, and they don't kind of get the fanfare of the other companies, but they have one of the most powerful hybrid AI models out there. They partner with NVIDIA with a lot of stuff. So if you just kind of like, look at their website and see what they're doing. For example, now they're working with Korea Quantum to use supercomputing and AI to better target potential attacks for defense purposes. Now, think about what's going on in the world, right? Just every day, what we have going on in the Middle East, Russia and Ukraine, the Iran strikes the other day. I mean, this information is so highly valuable that you can't imagine that there won't be a lot of government spending going into this. And then not to mention, smart cities, electric cars, healthcare, all the just tech in general, right? All the stuff we usually talk about, but there's a huge need for this. And IBM is really a leader there.
Sylvia, what is verboten? What do you not like?
What do I not like? So I think that like it'll take a while for the small caps to really start to rally. It's not that I don't like them. It's just that I think I'm allocating more towards the names that are moving, which right now are going to be, kind of tech, semiconductor, like some of the consumer stuff. I like healthcare, all these weight loss drugs and things like that. I mean, look at Lilly earnings this morning, they're taking off. So, I'm just not going to allocate too much to utilities, and I'll probably wait a little bit to get into small caps. And you know, again, I don't think they're bad investments because I do think breadth will expand, but I just think there's a little bit more ROI in you know, kind of the tech sector for now in semiconductors.
So in your ETF business, Sylvia, where are you seeing the flows these days?
So we have seen, you know, two places really. One is, again, that quantum AI trade, right? We for one of our ETFs is at the highest level it's ever been, quantum, just because people are interested in that theme. And then there has been so much flow for Defiance and for our competitors in income ETF products. So ETF products that use different types of option strategies to generate income for investors. So we have like put right strategies where, you know, we have S&P exposure and we sell puts to generate income. Other companies are doing it on single name stocks and things like that. So there have just been billions of dollars pouring into that enhanced income space. And the idea there is like you get a little bit of upside. It's almost, you know, Alix, to like, what do you do, right? So you get a little bit of that index exposure, but you're still just getting income. So you kind of have this like guaranteed income and then, you know, some portion of equity returns. So you have a smoother ride than if you just invested in the index, for example. So it's kind of like tapping back in from Treasuries trade.
So not what Paul said. Don't do the index fund, but not the gold bars in the soup can.
Yeah,
so,
you know what Paul said plus. So what Paul said plus
exactly.
and maybe a little less downside if there's a black swan event. But you know, it can go either way, right? If the markets just completely rally, I mean, S&P and NASDAQ, they don't usually serve you wrong. So
good stuff. Hey, Sylvia, thanks so much for joining us there. Sylvia Jablonski, Chief Executive Officer, Chief Investment Officer, does it all for Defiance ETFs, joining us via Zoom from New York City here.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.